After you invest in a stock, it starts dropping and you lose your money, right? It happens with all of us. But you have to understand the market, otherwise you won't get a single penny from the stock. So let's understand and apply the lessons from this legendary book by Peter Lynch, who is one of the most successful and practical investors of all time. So der kis baat ki, let's get started. Take benefits from what you already know. The best way to find out stocks is what product you are using or what product or service you are seeing people are using the most. The great investors do not own the company, they don't understand their business model. You can find tomorrow's big winners by paying attention to the new developments at the mall, at the workplace, at the restaurant or anywhere. You should first define your objectives to investing, such as why do you want to invest in stocks, what do you expect to get out from them, how long have you wanted to invest money, are you a short-term or long-term investor, how do you react to a sudden drop in the price of your stock, etc. The 6 categories. Peter Lynch classifies stocks into 6 categories that cover all of the useful distinctions that any investor has to make. The 6 categories are: number 1, the slow growers. These are big companies. A sure sign of a slow grower is that it pays regular dividends. Companies pay dividends when a company doesn't seem an opportunity to invest money in any project. Number 2, the stalwarts. Not so big, not so small. These are medium-sized entities that tend to rise faster than slow growers. Depending on when you buy and at what price, decide your profit in stalwarts. Number 3, the fast growers. These are small, fast-growing companies that grow at a rate of 20 to 30% a year. Here is where you find multibagger stocks, and this book is all about finding multibagger stocks. Fast growers do not necessarily have to belong to a fast-growing industry. Number 4, the cyclical. These companies react based on economic conditions and the business cycle. When the economy is good, companies rise. When the economy is in recession, companies fall. Timing is everything in the cyclical. Number 5, turnarounds. Turnarounds are no growers. These companies are in their financial recovery stage. Number 6, the asset plays. The assets play companies are sitting with something valuable assets that you know but other participating are unaware of. The valuable assets may be anything, it can be cash, real estate, something intangible, etc. Big companies, small moves. The size of a company can give you an idea what you can get out of stock. Big companies don't have big moves and it's hard to get multibagger from them. Big companies are mathematically impossible to double or triple in a few years. You can only get multibagger in a small companies. There is nothing wrong with big companies, but you just have to know these companies so you won't have wrong hopes and unrealistic expectations. 13 attributes of a perfect company. The best attribute of a company is that any idiot can run this business. The 13 most important attributes of a perfect company are as follows. Number 1, it has a dull and even ridiculous name. The perfect stock would be attached to a perfect company. The perfect company would be in a simple business, and the perfectly simple business has to be a boring name. The more boring it is, the better. Number 2, it does something dull. Get even more excited when a company with a boring name has does something dull or ridiculous, such as making a bottle cap. Number 3, does something disagreeable. The boring name and doing something disgusting at the same time. It is a spin-off. Spin-off is a creation of a new company with an existing business or a part of a company seen to separate. Number 5, the big companies don't own it and the analyst doesn't follow it. Find a company with a very small or no institutional ownership. Then you have found a potential winner. If you find a company that has no analyst ever visited or no analyst wants to know about, you have got a double winner. Number 6, it's involved with toxic waste. The waste management companies are the perfect example of toxic waste. Number 7, something depressing about it. If there is something stock market participants ignore besides toxic waste, it's morality. Number 8, it is a no growth industry. Many people prefer to invest in a high growth industry, but not Peter Lynch. He prefers to invest in a no growth industries like plastic, bottle cap, etc. because there is no problem with the competition. Number 9, it has a niche. Prefer investing in companies that have a niche. Here is also no problem with competition. Chemical and drug companies have niches because its product no one else is allowed to make. Number 10, people have to keep buying it. Invest in companies where most people go again and again for buying the product of a company. Example, cigarette companies. Number 11, it is using technology. Rather than investing in high growth industry companies, why not invest in companies that benefit from them? Number 12, the insiders are buyers. The very reasons insiders are buying is because they think that the stock price is undervalued, and if you buy the stock before insiders, then you will make a potential profit. Number 13, the company is buying back shares. Buying back shares is the best way to reward its shareholders. When a company buys half of its share, then your earnings per share also got double if earnings remain the same. The 2-minute drill. After you get the idea of what kind of stock it is and whether the stock is undervalued or valued relative to its fundamentals, before buying the stock you have to able to give a 2-minute monologue of the company, such as why you are interested in it, what are the pros of the companies, what are the cons, what company have to do for success, etc. 5 stocks to avoid. Be the next something. The companies like next Apple, next TCS and the next Reliance, avoid it. Avoid diversifications. The companies, instead of paying dividends and buying back shares, they are investing their money in foolish acquisition. Be the whisper stock. Avoid the stock despite you getting suggestions from the best investors you know. Be the middleman. Don't invest in companies whose most of the sales come from one or few clients. Be the exciting name of the stock. A flashy name in a bad company attracts investors and gives them a false sense of urgency. Other than these 5 stocks, if you could avoid a single stock, it would be the hottest stock in the hottest industry. There is always something to worry about. Every day brings something different to worry about. Inflation, recession, depression, natural disaster, war, market crash, and even the bus when you cross the street. In the last 100 years, the market has seen it all and recovered. You can wait for the sky to fall, or you can invest knowing it will happen. You will get through it and the market will too. Learn from your mistakes. Every great investors I have come across owns their mistakes. They focus as much, if not more time studying their mistakes than they do their successes. Every investment they make has a theory behind it. Whether they make money or not, they ask, why was the theory right or why was it wrong? Know what was wrong so you don't repeat it. If you need the money, don't invest in stocks. Lynch was straightforward about not taking chances in the short term with money you can't afford to lose. Money needed in the next 2 or 3 years should be kept in low risk investments. Stay away from the quick buck mentality and stick with investing for a long term. If you spend more than 13 minutes analyzing economic and market forecasts, you have wasted 10 minutes. The economy and the stock market are not the same. The economy is a huge machine with hundreds of moving parts that make it impossible to forecast its future. A company, however, is a singular part that can be simply measured. You can waste a lot of time trying to find out where the economy is headed, or you can spend the time finding out what's happening to the company, trying to catch the bottom on a falling stock. It is like trying to catch a falling knife. Stocks fall for a reason. Sometimes management fixes the problem and the stock recovers. Oftentimes they don't. Lynch was great at finding these turnaround stories, but he warns that management will always tell a great story. Stocks of bad companies will fall further when the story ends up being a fairy tale. It's always better to wait until a company has proven itself and the stock turn before buying. After a great run, don't be afraid to get out early. At the height of Lynch's success, he called it quits. That was 1990, just before one of the biggest bull markets in history. He managed thousands or more stocks and ran the biggest mutual fund at the time. All your stocks will not do well. You only need a few good stocks in your lifetime. If you have a lots of stocks, some will do mediocre, some will do okay, and if one or two of them goes up big time, you produce an extraordinary result. Thank you so much for watching this video. See you in the next video.